Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis, welcoming you to Money Talk on Tuesday the 18th of August. On this podcast, we cover the latest business and finance news from across the Asia-Pacific region, and thank you very much for listening. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 100 million customers across 13 countries. In today's business and finance headlines, China's economy weakened across multiple fronts in July, with fresh data showing a sharper slowdown in consumer spending, a deeper contraction in investment, and rising labour market strain. Retail sales grew just 0.6% in July from the same month a year ago, slowing from 1% year-over-year growth in June and well below expectations of a 1.5% jump. Fixed asset investments fell 6.7% in the January to July period, dragged down by a 19% plunge in property investments, and the urban unemployment rate stood at 5.2% in July, ticking up from 5% in June. Japan's economy slowed more sharply than expected in the second quarter, complicating the Bank of Japan's efforts to justify a near-term rate hike. Real GDP grew 1.1% annualised, well below the prior quarter's 1.9% pace, and missing forecasts for 2% growth. GDP grew 0.3% compared to the last quarter, also missing expectations of 0.5%. Donald Trump said he would substantially reduce joint military exercises with South Korea, touting his very good relationship with North Korea's Kim Jong-un. Trump said the drills send an inappropriate and hostile message to North Korea at a time when he claims Kim Jong-un is being unthreatening and respectful. Japan's 10-year bond yield hit a 3-decade high Monday, approaching the closely watched 3% level, as a weak yen fuels inflation concerns and investors bet on an interest rate rise next month. The benchmark 10-year government bond yield touched 2.93% on Monday, reaching its highest point since 1996. On today's Money Talk, we're joined by Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Lashar, Asia Chief Economist at BBVA, and in Washington DC, our US Economics Correspondent, writer and broadcaster Barry Wood. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street's Monday, US stocks initially rose on expectations that massive spending on artificial intelligence will continue, but renewed optimism around AI wasn't enough to keep the major indices in positive territory. The S&P 500 index fell 0.5% to end at 7,745. The Dow shed 273 points, or 0.5%, to close at 53,460. The Nasdaq Composite moved 0.33% lower to 26,645. Treasury yields jumped to a 19-year high on Monday as traders looked ahead to the release of the minutes of the last FOMC meeting due later in the week, and as Brent crude oil prices rose above $90 a barrel. The 30-year yield climbed 5 basis points to 5.31%, its highest close since June 2007, and the 10-year yield ticked higher to 4.73%, up 4 basis points from Friday. In the currency markets, the dollar index was down as much as 0.4% at 99.29 before rebounding to end the day unchanged at 99.59. The Japanese yen traded 0.1% weaker at 159.5 yen against the dollar on Monday, having given back a significant portion of the gains triggered by last month's coordinated US-Japan intervention. The offshore Chinese yuan was 0.1% firmer, around 6.74 renminbi per dollar on Monday, hovering near its strongest level since February 2023. And spot gold settled 0.9% higher at $4,416 an ounce. Brent crude oil futures for October delivery rose 2.7% to $90.87 a barrel, and Bitcoin was last seen at $64,300, up 2.1% over the past 24 hours. Technology stocks lifted Asian equities after stellar revenue growth at Anthropic bolstered the view that massive spending on artificial intelligence will be sustained. The MSCI Asia Pacific Index rose 0.3%. Japan's Nikkei 225 added 0.7% to 69,220. South Korean markets were closed yesterday for a public holiday. Mainland China's CSI 300 advanced 1.6% to 4,741, and Hong Kong stocks rebounded from 4 straight sessions of declines. The Hang Seng Index was up 336 points, or 1.3%, to close at 25,453, led by technology stocks. Futures markets in the region pointing lower this morning. The Hang Seng set to start the day with losses of 0.4%. Looks like the Nikkei 225 in Japan is also going to fall 0.4% at the open.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our Tuesday morning guests. We have with us, as always, on a Tuesday, Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia. Morning, Mark.
Good morning. Good evening, Barry.
Over in Hong Kong as well this morning, we have Lashar, who is Asia Chief Economist from BBVA. Morning to you, Shark.
Morning, Peter.
And over in sunny Washington, D.C., we find our US economics correspondent, Barry Wood, hopefully enjoying the latter days of the summer there.
I am indeed. Good morning, Peter. Good morning, everyone.
Let's start with China. As we heard in the introduction, China's economy weakened across multiple fronts in July, with fresh data showing a sharper slowdown in consumer spending, a deeper contraction in investment, and rising labour market strain. The July figures highlighted a widening imbalance between China's booming high-tech export sector and its struggling domestic economy. While shipments of semiconductors and computing equipment helped lift exports by 24% last month, household spending has softened markedly, weighed down by weak confidence, a multi-year property downturn and shrinking mortgage demand. And new bank lending in July recorded its largest monthly decline on record, with household loans contracting again after a brief June rebound. The National Bureau of Statistics said China must accelerate the transition to new growth drivers while calling for greater reforms and opening up further. Mark, your customers at IMA Asia, your companies there, are sort of a bit of a leading indicator for China. So I guess none of this is a surprise, even if the slowdown is quite marked.
No, it's not surprising, but it's disappointing, of course. And, keep looking for something that is going to stimulate, especially consumer spending, and obviously that affects everyone. Autos were down auto sales were down 17%, for example, and mobile phones were up, but that's a buy-in program that's going to expire soon, or certainly going to have less of an impact. So, is the Chinese government going to take any measures that are going to deal with some of the serious economic issues, like consumer spending, like property, and so on? And if they are, what are the implications? Because obviously there's some risk involved with this as well. The signals still aren't clear, and for companies trying to navigate their business in China, it makes it more difficult, frankly, as it does elsewhere too. But China has always been the hope, and so far, not much is going on except in a few sectors.
Yeah. I mean, Shark, what's your analysis of this? There's a lot of elements to this, but maybe the most alarming bits, but we'll see what you think, is the collapse in investment. It really has been quite sharp, hasn't it? And we saw new bank lending in July record its largest monthly decline on record. That sort of suggests that there is really a lack of confidence in the economy at the moment, which is stopping businesses, stopping households investing.
Yeah, I think the investment decline mainly reflect the lack of the confidence, particularly for this property market. I think they have been in correction for several years, but at least in terms of their property investment, so far we haven't seen it bottom out yet. Maybe this kind of downturn in the real estate sector will continue for a longer time. And at the same time, if you look at the money side, I think the one problem is the government, they didn't invest enough in infrastructure investment. because this year they have a 4% budgeted fiscal target. But so far, if you look at the progress of this implementation in fiscal policy, they are not loosening enough as they planned, we can say. So local government, it seems that they lost their interest in infrastructure investment. Maybe they need to, I think now that the local government officials, they have less incentive to do that because of this anti-corruption campaign continued. If you are very interested in that one, if you do a lot of the infrastructure investment, maybe that could bring you some unnecessary troubles to all these local government officials. At the same time, now the Chinese officials, they have a more target KPIs for the local government officials. Now they are more interested in investment in AI-related things, okay? But rather than do this traditional infrastructure investment. I think that's a problem. They need to crack this one as soon as possible. Because many people, they said China need to have additional stimulus. But the problem is, even you already promise to invest that part, you haven't finished that one. How can you persuade the central government to assign more financial resource to you?
Yeah. But Barry, there's a global aspect to this, which I'm wondering if you could provide some thoughts on. And we've had data now from the world's three biggest economies over the last few days, from China, from Japan, from the US, all showing really that the economy is starting to slow and consumers are losing confidence in all three places. I'm wondering if maybe the global economy is running out of luck here because we're starting to see perhaps the impact of the Middle East war and of tariffs, which hadn't really hit as hard as perhaps economists were predicting sort of 6 months or so ago. But I'm wondering if we're now starting to see the impact of that around the world.
Well, I think you're right. You're onto something, Peter, because this isn't a slowdown. You can't really call it that yet, but the trends are not positive, and consumer confidence is weakening in those three big economies that you've just mentioned. And, you know, in terms of oil prices and the impact of the war in Iran, you know, David Roche has been predicting that oil prices will bound upwards unless there is a resolution, because the supplies and the use of reserves, you can't do that forever. So, yeah, there are some ominous signs here, but not yet a trend.
But we got to oil now back above $90 a barrel. I mean, one of the things that had kept it low was Chinese withdrawing from the market and drawing down its reserves rather than importing. It's now an importer again. It's starting to buy oil once again. We're seeing those reserves run down to almost critical levels now in some countries. It's hard to see, isn't it, that oil is not going to do anything other than go up, and that's going to have an impact on inflation.
It certainly could. Let's just hope that Donald Trump's floundering, seeking some magical solution to the mess that he's gotten the world into in Iran, that he can find some solution, and that would, of course, have a reverse effect on oil prices. I want to ask Mark, did you say that car sales in China were down 70% or
17, 17.
17. That's still a very big drop.
Yeah.
And that's because it's presumably because it's such a cutthroat market. You know, the domestic manufacturers just can't make money there. It's so cutthroat, and there's a reason why they're exporting, where there's bigger margins overseas.
And they had the
want into the U.S. market, don't they?
Yes, yeah. Well, they can't export there, but certainly into the EU, where all the big manufacturers, and you only have to look at, for example, the German manufacturers. What's happening to them at the moment? They're really being squeezed out of their own domestic market right now because of China.
And also to make you even feel better, Barry, home appliances and furniture also declined substantially. So.
Wow.
And what can be done? I mean, Shark, what needs to be done to sort of build up confidence again? Because China right now is just firing on one cylinder, isn't it? Which is really exports.
Yeah, I think now my suggestion is that they need to boost this property market as soon as possible. I think they already missed a lot of the opportunities. So this problem have lasted for longer time. So I think now the China must have some game changer policy to boost their real estate sectors. I mean, at least I don't expect that they can have a positive investment in this property sector soon, but at least they need to use the policy to stabilize the price. Now the price already cracked in 30-40%, depends on different cities, and this kind of downturn lasts for almost 6 years. So they must do something to boost that one. So I would like to suggest that maybe China consider to substantially lower the mortgage rate for all the new home buyers. Yeah, now they have a mortgage rate like around 3%. So I think they can, if they can lower that one to 2% or even lower than 2%, I think that will help a lot.
Well, the PBOC is going to decide loan prime rates later this week, isn't it? The 5-year loan prime rate is linked to mortgages. So do you think they will act this week?
I'm not sure about this one, because the problem is now they are going to adjust this January interest rate. So that one means it's not only for the mortgager, but also it applies to January economy. We know that the China's banking sector is quite depend on this interest rate margin, but now it's already at a very low level. If you generally lower that one, okay, you will maybe your banking sector have problem. So they have a lot of the constraint for this kind of a policy change. But what I mean is at least you can targetedly to make some wound on this real estate sector, and that means not only the PBOC, but maybe the Chinese central government, they can do something. Yeah, they can directly have these subsidies for these home buyers. Okay, if you pay your mortgage, okay, I can subsidize 1% for your mortgage payment. So I think they still have the policy choice. It depends whether they are willing to do it or not, right?
Well, Shark, isn't the challenge for the authorities that you could cut the mortgage rate to 2%, but if prices for flats continue to decline, I would think consumers are going to be reluctant, even at 2%, to buy.
It could be, but at least I think you should try this part. Okay, you should try this one. Otherwise, they have done these subsidies on consumers, but now we see that auto sales still continue to decline because no one can buy buy 2 autos in 1 year, right? You must wait for more years. So they already front-loaded their buying. But for this housing market, I think definitely they still have something to do, right? If you cannot do 1%, is not enough. You can subsidize 2%, okay? Yeah, or even have this free mortgage, okay? I mean, interest rate free mortgage. Yeah.
But Shark, but what do you think stopping the Chinese government from doing any of this, taking any of these moves? It seem very reluctant. Are they worried about ramifications, negative impact?
Yeah, I think the one thing is, as I said, now they don't want to make a big change on this. I mean, the regulator side. They don't want to. I always suggest that maybe the Chinese authority, they consider to have this national housing bank. So just like Fannie Mae, Freddie Mae in United States, that means the central government that directly subsidize these home buying things. But I think that they are reluctant to do that one because there's a lot of the interest conflict inside the government. That's one issue. Another issue, I think that now many Chinese high-rank officials, they think maybe they can boost this AI-related industry, and through this one, they can boost the general domestic economy. But I would like to say, if you compare the current size of this AI-related industry, maybe they account for 10%, okay, of the GDP, but the rest, 90%, they're still suffering this lack of the confidence. They're still suffering other problems. I don't think their plan can work in just a couple of years. So that's why I think they need to do something. Yeah.
What do you make of Hong Kong's economy? Hong Kong confirmed its 4.3% GDP growth for the second quarter. It's a slowdown from 5.9% in the first quarter, but nevertheless quite a decent rate. Mark, what are your companies at IMA saying about about Hong Kong?
Well, for most of them, they're glad to see it, but for many of them, Hong Kong is not exactly their largest market. They want to move forward. I mean, some in tourism and so on, but it does. There are issues involved with this, but it does feel a little bit like Hong Kong is doing better than it was. If Hong Kong isn't quite back, I'm not sure if it's back, but certainly in terms of the concerns that were there before, but still, as even the financial secretary has pointed out, he says they might raise the forecast for this year, but at the same time point out that Hong Kong is still very vulnerable to what's happening around the rest of the world. And if there are problems with the wars we're having, if oil prices continue to be a problem, et cetera, Hong Kong obviously would feel the effects of this. So not quite out of the woods yet, but certainly a little light at the end of the tunnel, maybe, at least for a little bit.
Shark, what are your thoughts about Hong Kong?
Yeah, but now we are I think our current situation compared to 2023, that's only 3 years ago, much, much better. Okay. Yeah. So let's enjoy the better situation in Hong Kong. Of course, I fully agree with Mark because Hong Kong has got small economy, and the recent improvement quite related to the improvement in capital market. And we do see that Hong Kong government, they try to do more to improve the financial structures, in the city, and also they want to introduce more business, RMB, offshore RMB related business to Hong Kong. I think that they are doing many things, but still we can see up and downs. As Mark said, we are small economy, so we're quite vulnerable to important change around us. What happened in China, what happened in the United States could have negative impact on Hong Kong. But at least you see that overall the global consumer confidence is declining. But in Hong Kong, I think at least it's still stable. Yeah.
And Hong Kong...
Soon we're going to see the 5-year plan, at least the initial plan released. And for Hong Kong, that's a revelation, right? We've never had one before, so we'll see how that affects the economy.
Yeah, I wonder what Milton Friedman would make of that.
Yeah, would not be a big
Mark
support.
and Shark, I'm really puzzled by what seems, at face value, a contradictory move from Beijing and the Hong Kong authorities. On the one hand, to cut the tax on hedge funds and private equity in Hong Kong to sort of prop up and revive the financial market. And yet Beijing has got this 20% tax on capital gains. I mean, what's the next effect on that for the Hong Kong financial market?
Yeah, that's a very good question. I think that Beijing, the governance model in Hong Kong is, in the past, is totally independent from Beijing. So Hong Kong doesn't need to pay tax to Beijing, and they run by themselves. So I think that now if you look at the current change in Chinese regulatory system, they are trying to fill in the loopholes, okay, on their current account, on their capital account management. They make sure that all the money China make not easily invites the overseas. I think that's related to Chinese case, not related to Hong Kong. But Hong Kong, they will continue to be a offshore market for China, not only for RMB but also for Chinese rich people. Okay, if you already have moved your money outside China, you can just put your money here in Hong Kong. So I think the impact on Hong Kong financial sector for the short term, they must have some negative impact. Okay, but in the long run, I think United States have a capital gain tax, UK have a capital gain tax, Europe have a capital gain tax. So every I would like to say advanced economy, advanced country, they have these kind of things. I think in China, the Chinese rich people or the Chinese residents, okay, they can withstand this kind of normal of this capital gain tax. In the long run, I think it shouldn't have negative impact on Hong Kong or China, because it's just a naturally change of their regulatory system. Yeah.
I mean, Hong Kong wants to, well, it is a wealth management centre, isn't it? It's competing very competitively with Singapore. Singapore is snapping at its heels to also be the world's biggest wealth management centre. And we know that mainland Chinese people hold a lot of assets in Hong Kong. A lot of these offshore trusts are here in Hong Kong, where the government wants to sort of tax them. So does it affect Hong Kong's sort of status as a global wealth management hub?
As I said, I don't think so, because other countries, other tax authority, they have similar ones. Okay, in the past they enjoy. The people they holding assets in Hong Kong, they enjoy this tax-free benefits. In future, maybe they need to pay tax to China, but I don't think that will have a negative long term. The negative impact on Hong Kong, because in future maybe they don't have a tax advantage for Hong Kong, but they can compete in other service. Okay, they can provide high quality wealth management service, and you can keep the money. It's a challenge to Hong Kong. I agree with that one. You must compete with other countries because now you are on the leveled playing field. Okay, but I don't think. I believe Hong Kong can adapt to that.
Yeah. Mark, why does Hong Kong need to cut taxes? It's having this sort of big bang approach at the moment, isn't it? Cutting taxes for hedge funds and venture capital firms, family offices, and so on. Is it a signal that maybe, it really needs to step up its game to compete with Singapore? I mean, the taxes are pretty low in Hong Kong already.
Yeah, and I tend to agree with you. Shark might have a better view on this, but I'm not sure why they're doing it either, other than feeling that they have to do something for competition. Hong Kong, the tax breaks they offer, again, whether it's for this sort of thing or for its investors and so on, they're so low to begin with. I don't think many companies would see that as an incentive, but I guess in this very competitive world, you're trying to look for just some advantage that might entice investors. But I don't know. Shark may have a different view. I'm skeptical of that as well.
Shark, do you think Hong Kong needs to cut taxes to remain competitive when it's only 15% to start with?
I'm not sure on that one, but it seems that at Hong Kong, they want to strengthen their competitiveness in this tax arrangement. Okay, because other people, they are doing that one. Hong Kong, they try to imitate other people.
Okay. Well, look, we need to turn our attention to the US. We've had quite a bit of data there as well. Fresh signs of consumer weakness in the US also. Retail sales fell by 0.6% in July, falling short of the 0.1% increase that economists had expected. And sales in the control group of categories, which exclude things like petrol, gasoline stations, they fell as well by 0.4%. That's the first decline this year. And also in a separate report, the University of Michigan's Consumer Sentiment Index dropped 7.6%. That's reversed the last 2 months of gains. Sentiment fell particularly sharply among lower income groups who pay a bigger proportion of their income on food and energy. And taken along with the weak reading on July job gains, maybe, Barry, this is pointing now to a softening for the American consumer. What do you think?
Yeah, I agree with that, Peter. I think it is pointing to a softening in the U.S. economy. I think growth is still around 2%, but that data is not good. Retail sales down, consumer confidence down rather sharply after 2 months of gains. So that's difficult. I will go out on a limb, and maybe that's a dangerous place to be. But I think that inflation is on a level trend and slightly down. And that means that we get an inflation report before the next Federal Reserve meeting, which is the 16th of September. And inflation CPI data will come on the 11th. I've got a feeling that despite the 10-year rising and expectations that there'll be an interest rate rise, I think that the Fed is likely to remain neutral and not change anything in September. We'll know a lot more in 10 days' time when we get Jackson Hole and all the central bankers pontificating about how they see the world. And then we've got this G20 finance ministers meeting in Asheville, North Carolina. So that's my prediction. I don't think there's going to be a rate hike in September.
I mean, I remember when we spoke about this a couple of weeks ago, you said a similar thing, that you didn't think the Fed needs to raise rates. Since then, I mean, to be fair, the data has supported your view there. It has come in weaker than expected, whereas inflation is sort of steady, as you say. So it does take the pressure off the Fed a bit, doesn't it?
Well, you have been among those, Peter, saying, look, why don't they raise rates? You've got a high inflation rate well above target. You're right. But at the same time, it's a weakening economy. So we shall see.
How much is the Iran war influencing consumer psychology? Is it something that is having an impact on consumers' inflation expectations or their expectations for prices in a year's time? And is that weakening?
I think, yes. As listeners know, this is an economy that is really automobile dependent. Therefore, if the oil price is rising, that increases the fuel price. And that really impacts. It's not surprising that a lot of American workers are commuting 50 to 70 kilometers each way per day. And, that adds up if you're buying fuel, even though our fuel prices relative to Europe are very low. So, I think the answer to your question, Peter, is the Iran war has impacted the American consumer through higher gasoline prices. And that's the extent to which I think that they really watched that development in Donald Trump's handling of the war.
And this is affecting voting, isn't it? A majority of US voters are now saying they're worse off under Donald Trump. And we had an FT poll over the weekend, which said, conducted by Focal Data on behalf of the FT, they found more than 53% of registered voters said their finances had deteriorated since Donald Trump returned to the White House in January 2025. Almost 57% of independents and nearly a quarter of Republicans also felt worse off under the current president. And the FT poll found 55% of voters disapproved of the job Trump was doing as president, including nearly 20% of Republicans. There's some big warning signs here, aren't there?
Yes, there are, Peter, and that's really true. And it goes right back to the tariffs. The tariffs have not evolved in terms of stimulating consumer demand in the way that President Trump predicted back in March, April of 2025. And the war has exacerbated the problem because you had relatively low fuel prices, and they have risen since February. There was a modest decline, and now, as you quoted the Brent crude price this morning, it's rising again. So it all really depends on fuel prices, I think.
Shark, what are the implications of this for the Fed, do you think?
I think Fed, they are going to keep the interest rate unchanged until the end of the year, and the next year maybe they will lower the interest rate rather than higher the interest rate. So, yeah, it's quite in line with our expectation. But we don't have a monetary policy meeting in August, right? So, yeah, let's see. They still have the time to find more data out there, and I think the Fed governors, they will chew on this one, and then they will make decision in September. I will bet that they are not going to hike the interest rate further.
Well, that's interesting because Fed fund futures markets do think there'll be a rise before the end of the year. It's come down now for September, but they still think the odds are on for a rise before the end of the year.
Yeah, yes, that's true. So compared to these market views, we are a little bit dovish. Okay, yeah.
Mark, what are you sensing in the US economy from companies out here?
Well, I mean, they're some of them are doing quite well, and I think there's concern. The interest rate situation obviously worries them, and so do fuel prices, etc. I mean, it's the impact. But saying that, for several of our companies at least, the U.S. market is doing pretty well. The economy is pretty strong in a lot of different areas. I know some people don't feel it, but some companies are feeling it pretty much, and we can see that, of course, in the response. And I tend to agree with. I don't know as much about interest rates as Barry does, but it does seem to make sense for me that there's not going to be much of a change in the short term, or there's likely not to be, unless something changes again in the economy with the war, with oil prices and so on. But at this point, I don't see the reason for raising rates.
Well, I mean, Barry, the markets might be doing it for the Fed, might they? And for the Bank of Japan as well, actually, because we're seeing bond yields, 10-year bond yields, rise substantially in both markets. In Japan, the 10-year yield is now at its highest since 1996. In the US, it's at the highest level since 2007. And what is significant about both these markets is the enormous amount of debt that's been built up in both Japan and the US. It seems like the bond markets, the bond vigilantes are back. They're starting to demand that even if the Bank of Japan and the Fed aren't going to do anything, they want higher rates to be compensated for all this risk.
Well, Mark is the expert on Japan on this panel, and it seems to me that with negative interest rates in real terms in Japan, despite some weakness in the economy, the Japanese are going to raise rates. I mean, this is something that. Am I not right, Mark? Isn't that likely?
Well, it looks like it's likely. I mean, they almost have. They're not going to move quickly, but they have to do it. I mean, they may do it quickly, but they're not going to not a big jump. But at the same time, there's not a lot of confidence in Japan in the economy, in part because the yen goes up and down, it remains weak, but also this big spending program the Prime Minister is still talking about. And I'm not sure where that money is going to come from and how that's going to affect the economy. And as Peter mentioned, the debt is reasonably high in Japan, one of the highest in terms of GDP in the world.
Well, I think that
it's domestic, but there's
the
concern.
BOJ, the Finance Ministry, and the U.S. Treasury must have their eye on this Japanese yen exchange rate because, as Peter suggested at the beginning, it's creeping back up towards 160. And that can't be good news for these interventionists who, got it down to 157, and some said it was going to go to 155, but it hasn't. So what are they going to do now?
So things might get exciting in Nashville in the next week or so, I think.
Shark, if Japan 10-year yields go above 3%, that's the critical level where market watchers are focusing on, and it's pretty close at the moment. It's about 2.95%. Are we starting to get to the level where investors start repatriating assets back to Japan?
I'm not sure about this one. I think that now Japan, they need to hike their interest rate. But unfortunately, due to the high level of their debt, they are constrained. So they were very reluctant to do that. But now I think they try to make some adjustment on that side. They might hike interest rate next month. But overall, I think that the situation is not that good because if you have such a higher long-term interest rate, is not good for the that sustainability for the country. They must make move quickly. Maybe they will jointly intervene the market again soon, but they must find a better way to do that, to make the market believe that it's unreasonable to see such a weak yen. So they need to persuade market to turn their views. Yeah, well, but it's hard.
The only way, surely, is for the Bank of Japan not just to raise rates once, but to keep on raising them for the next 2 or 3 meetings, to get yields back into positive, to get interest rates back into positive territory. That surely is the only thing that's going to convince the markets. One rate hike in September, and then another 6-month wait for the next one is not going to do it.
Yeah, you're right. I think the one interest rate hike is not enough to change everything. Yeah.
But is that going to happen, Peter? Of course, logically,
it's not going to happen.
Correct, but it's not going to.
It's not. But it's what they should do, in my view. But I don't think they will do it. And now, of course, they've got a slowing economy. Real GDP grew 1.1% last quarter. It slowed quite considerably. So it sort of gives the Bank of Japan yet another excuse to prevaricate and not do anything. So Shark, how do they reconcile this?
I have no idea. Yeah, fortunately, I'm not Prime Minister of the Japan. So, it's very hard.
Their unofficial or maybe official financial advisor, Mr. Scott Besson, will be seeing the Japanese leadership very regularly in the next few months. So even if he doesn't go to Japan, I expect there'll be a lot of interaction between the two because that seems to be a priority for him as well.
Scott Bessent is the governor of the Bank of Japan, isn't he?
Yeah,
I thought he was.
Well, we haven't heard from the real one recently, so that's a good point as well.
Indeed. I mean, these long US yields, Barry, we're wondering what could be a catalyst to bring the equity market rally to an end. I'm wondering if this could be it, because as these yields in the US get higher and higher, it raises the costs of funding for all these companies that are making massive expenditure on AI and having to borrow now to be able to do that. I'm wondering
that's true, Peter, but they're so rich. We're talking about...
Well, not anymore, though. They used to be.
Magnificent Seven, who've got all this cash. Yes, you're right. They've spent a lot of it, and they have to borrow. But I don't think that an interest rate change in modest proportions is going to impact that. But I could be absolutely wrong. The reality is that I sort of see that trend line. There's been no action from the Federal Reserve for 5 straight sessions, right? Or is it 6 with the latest? But So I think that will continue. And as Shark predicted, there might be a cut before the end of the year if the economy continues to weaken.
And that could send the 30-year yield even higher because people,
it could.
Bond investors.
But I don't think anything. You're asking the question, Peter, of what's going to end this rally in United States equities, and I think an interest rate rise could do so.
Shark, what are your thoughts on this? There's $40 trillion of debt in the US. 30-year yields now 5.25%. This is significant, isn't it? It drastically increases the costs of the government servicing the debt, and as we're seeing, investors want higher and higher yields at the moment.
Yeah, definitely. I think this debt sustainability challenge is big challenge for United States. But fortunately, United States not alone because we have Europe. They have this high debt problem too. China, they have this problem, and Japan, they have this problem. So U.S. dollars is international currency, and so they can print this more U.S. dollar to help to solve this one. So now the market this one is not market focused yet, but I think gradually more and more people, they will turn their attention to this that sustainability issue in United States. then they could create more market turmoil in future. I think I would like to say for this year so far, it still looks okay. What I worry about in next year or next 2 years, at that time, if this AI continue to consume a huge amount of the cash, many of the firms in the United States, they will have a negative cash flow gap. In that case, who's going to finance this in the United States? Because the government sector in US, they're already in debt. In the past, they have a very strong the positive cash flow in the enterprise sector. But if the corporate sector in the United States, they have a negative cash flow. And then the financing is a big challenge for the entire economy. Yeah.
Okay, well, look, a substantial discussion there this morning on a whole range of meaty topics. Thank you all very much. You heard Lashar, who is Asia Chief Economist at BBVA. You heard Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia. And then over in Washington, D.C., our US economics correspondent, writer and broadcaster, Barry Wood.
You're listening to Peter Lewis's Money Talk.
Money Talk.
And thank you for listening to Money Talk this morning. You can find more details about some of the topics we've been discussing today at peterlewismoneytalk.substack.com. That's where you'll find my daily newsletter. I'll be back with another show tomorrow. Joining me then will be Simon Kavanagh, partner at BDA Partners, and John Schofield, Managing Director of Tempest Investment. And with a view from Japan is Tokyo-based strategist Nick Smith. See you tomorrow.
Money Talk.